Welcome to the Stay the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
Jonny Morgan, welcome to the show.
Thank you, Tim.
So where should we start? I mean, there's a lot of stuff to discuss. Where would you like to start? What do you think is relevant to the globe-trotting global investor of de nos jours?
Well, yeah, where to start? That is the question. I mean, Tim, you and I meet sort of regularly in the course of the year.
In a business setting, not just down the pub, as
absolutely,
I'm sure would suspect.
Yeah, although in vino veritas and all that. So I don't know, Tim. I mean,
okay, well let's frame this in the way. It's probably one of the last times we met was probably at the Oxford and Cambridge Club about 6-7 weeks ago. So my company, Price Value Partners, we present a presentation to corporate investors and prospects of our fund. It's a global Ben Graham equity value fund. And we tend to do the Oxford and Cambridge Club in London. And this is a nice opportunity to talk to people over a convivial meal setting and drinks and whatnot. And I guess in terms of trying to recollect how we frame that in relation to the presentation, and it's partly a reflection of the fact that my background is in the bond markets. So I spent the first 10 years of my career in the fixed income world. The Western government debt load is completely out of control. So we've rehearsed these figures ad infinitum. So probably everybody on the pod will know the figures more or less, but essentially just take the US, not picking on the US, it's simply because they're the world, the largest economy and the reserve currency and blah, 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 blah. We in the UK are in the same boat. US national debt officially now stands at $35 trillion and is growing at the rate of $1 trillion every 100 days. That debt will never be paid back, or rather, if it is paid back, it'll be paid back in severely devalued dollars. I'd say the rest of the West is in a broadly similar boat, and we had obviously the Liz Truss and the gilt crisis of a couple of years ago, and that for me is sort of ground zero. So whatever that's happening to the stock market, and we obviously had a huge amount of volatility last week in relation to reversal of the Japanese yen carry trade and all kinds of shenanigans. But for me, well, I suppose this is the question. For us, it comes down to, my God, we do not want to have any involvement in that market, and namely government debt. How do you feel about that as a contention?
Yeah, I think, you're absolutely right. I mean, what is it, 35 trillion public debt in the US, 120% debt to GDP. Assets versus liabilities is sort of third worldish. I mean, the piece of this jigsaw that I don't quite understand is, and I think, let me just qualify this, I think perhaps in the very short term, 6 to 8 months, maybe 12 months, there may be an opportunity in debt. I think longer term, parking money in debt, which is effectively a function of a currency, is a sure way to effectively lose purchasing power. And I think, as far as I'm concerned, and I know you share my view here, there seems to be, no conceivable way really that the show, can be stopped. When we lurch inevitably into the next crisis, there's going to have to be some sort of fiscal response to that. As our governments, particularly in the UK here, but I think, depending on what happens in the US, less so, continues to spend, profligate amounts of money on projects that are demonstrably,
absurd.
Absurd is a good word. I'm thinking of energy particularly. I know you share my views on that. No, I just can't see how. What worries me, Tim, at the end of the day, is most people that I speak to, certainly in the financial services sector, tend to be asleep at the wheel here. They just think that, a classic 60-40 portfolio is a Gore-Tex suit. You're not going to get wet. It doesn't matter what the weather throws at you. It's going to save you.
So for anyone that's unfamiliar, that's basically 60% equity, 40% bond portfolio, typically indexed against some kind of global benchmark.
Yeah, correct. So in the vernacular, if the equity market goes down, the bond market goes up. And as I qualified at the start of what I was saying here, there is theoretically a scenario where you could do reasonably well in bonds if you get it right, and the bond market does what it may do, which is this. I referred to it as this bull steepening, which is effectively the whole aspect of the curve shifts. But longer term, I would have thought bond markets with increased risks are likely to require more of a return for people to buy them. And if you then, apply what you and I agree on are the obvious consequences of inflation yet to come, I can't really see any reason why people are positioning long term in bond markets. So ergo, what's the answer to that? Well, certainly not equity. I mean, equity valuations, I think, at the moment are, frighteningly high. That's not to say equity markets may not go, a little higher and perhaps retest, certainly in the US, recent highs. That's entirely possible. But effectively, at some point, there will be a reversion to some mean. And again, depending on who you choose to read or listen to, that could be a brutal sell-off in equity markets, and it will be a global sell-off as well. So you could be looking comfortably, I think, at somewhere between sort of 30 and 60% when it happens.
It strikes me we've kind of put the cart before the horse, so we've sort of got stuck in medias res. But without sort of going into your background, do you want to give our listeners a précis of sort of who you are, what you do, and how you got here?
Yeah, sure. So I started in the city. I did a short service commission in the army in the 80s and early 90s, and then started in the city after that, stockbroking, and then moved, through the more institutional positions through Car Shepherds and then Investec. Car Shepherds became Investec, then moved across into a more private banking type role with Julius Baer, and then onto Hottinger. And then in late 2016, basically set up my own consultancy, focused on, a fairly close-knit client base. And the whole aim is to effectively help these clients navigate their way through, markets that I thought were very turbulent in 2016. And let's not forget, 2007-8 was pretty scary. I know the .com was pretty scary. I mean, the Asian debt crisis before that was pretty scary. COVID was a humdinger, that's for sure. So the thing that sort of really does make me increasingly cautious is the risk is manifestly larger today than it was when I set up in 2016. We are so much further down the track in terms of, as you said at the top of the conversation, debt, but in terms of overextended valuations, in terms of the sort of concentration of risk, the narrowness of the breadth in the level of equity markets. It's incumbent, I think, on me to effectively say to my clients and navigate my clients at this time through waters that I think could become extremely stormy extremely quickly. And when we saw just a week ago how aggressively markets can react to an event when we had the sell-off, not just in the Japanese market, but in the Japanese yen, both selling off in the region of 10%. I mean, there's very little you can do about it when it happens. The only thing you can do is to sort of sensibly try and anticipate these these actions and safeguard capital in that way.
Well, that's an interesting point that you make there, because how do you know that this is the big one, or whether it is the big one or not? Do you think that this is the big correction that leads to the 30 to 60% move that you're talking about? Or is it just another, or would it be just viewed as another buying opportunity for the market? What are the lead up signals that tell you that something like this might happen?
Yeah, it's a really good point, Paul. And the straight answer is, of course, I don't know. And that's why, I think there are times when, manifestly, that, the trend is up, and there are times that, it's too late to do anything about it. You're on the elevator coming down. I mean, Paul, I think you're a technical man.
Yeah.
Yourself, but what I have been doing recently is listening to a guy called Chris Vermeulen, who runs quite a brilliant technical space called thetechnicaltraders.com. I mean, at the end of the day, Chris, reflects my outlook on investing, which is, effectively you start off cautiously and you play what's in front of you. What effectively the fractals, the technical charts are telling you. Chris's view, and I agree with this, is that we're in a classic Sam Weinstein stage 3 topping phase. So the easiest way to think about that is a fairly sharp 45-degree angle up, then a top, then a drop, and then a little bit of what we'd call a bear flag, which is another sort of 45-degree angle out from that drop. And this is typically the sort of the final part of the market before we get the fourth and final stage, which is the sell-off. Now, the only thing that you can't really, with any degree of accuracy, predict is the timing. But what I think you can do is you can prepare ahead of, what is likely to occur, given these very powerful charting patterns, and position accordingly. Now, going back to the 60-40, typically the 40% you'd be carrying in bonds would be adequate enough to safeguard from the equity risk. That I don't think is the case these days. I mean, equity markets, as I said, extremely vulnerable given the valuations. That valuation is carried by so few stocks. Equity markets, generally, the wider equity markets haven't been that great, for the past 12 months. And bond markets, very, very difficult to say, whether they'll respond favorably in the short term. I suspect at the sovereign level they will. But we haven't even started to talk about, credit markets and, high yield debt markets, which again look absurdly overvalued. And if markets do sell off because of some sort of, well, the only reason they'll sell off is I suppose we get quite a significant economic slowdown. That's significantly going to affect credit. And once the whole thing starts to unwind, I would have thought, because everything is so interconnected these days, there's going to be very few places to stay safe. Very few.
But in the recent move, bonds did react. They did move higher. So there was a level of mitigation of risk by having that position. Are you saying that at some point you don't think they're going to react, or when would you be able to see that crossover where they stop reacting? Is that a period of time where you think that they just won't work as a hedge?
Yeah, I think, as I said, I think short term, they're as the yield curve effectively reverts to a more normal shape with the front end dropping as rates come down. And we've started to see that already. I mean, demonstrably, the yield curve is effectively, predicting what is likely to be the course of monetary policy going forward. I mean, what are we now at the UK? 5%. on the overnight rate. Well, the 1-year gilt is at 4.3%, and the 2-year gilt is at 3.8%. Well, who do you think's right here? You know, the Bank of England, who are driving looking at the rearview mirror, or you know, the bond markets.
But that's a really fascinating question, because I suppose I grew up thinking that there was such a thing as a free market, and the longer I stay in this industry, particularly in the current environment, the more I think everything is rigged, or they are attempting to rig everything, they're attempting to control everything. So I could bore for England on the topic of this book, 40 Centuries of Wage and Price Controls, which you can get through the Mises website. But essentially, if the clue isn't already in the title, it's that governments always try to intervene in markets. It always goes horribly wrong, and the intervention costs more than the putative good that I think they're trying to do. So you say which is right, but basically central banks have not infinite power and control, but they've got a meaningful amount, because they basically kind of in charge of the monetary issuance process. And if you can, and this is the most appalling thing that makes working this business almost have real moral misgivings about this. It's like, I think I'm correct in saying that firstly, the Swiss National Bank, for example, is you can buy shares in it, so it's a listed business. And secondly, they can then create money ex nihilo from nothing, and then they can go and put their ex nihilo money and basically buy Apple stock. But if you or I tried to do that would be deemed illegal and we'd go to jail. So you've got all these, you know, fun and games happening at the level of in the realm of the central banks. And we've all been lulled into the idea that that's somehow acceptable. We got by for hundreds of years before central banks even existed. So for me, I would be hugely excited by the prospect of people having a question about whose interest does central banks serve, and do they serve the interests of the free market or capitalists? And I think the answer to those latter questions is no.
Yeah, I mean, these you know, as you say, Tim, these are deep and pretty profound questions. Somewhat glibly, the way I tend to look at central bank policy is in that sort of very picturesque way that Friedman described it, which is the fool in the shower. And you know, imagine stepping into a shower that's freezing cold, and you turn the tap towards the warm and nothing happens, and you turn it again and then nothing happens, and you turn it twice and nothing happens, and you turn it 3 times and nothing happens. Then all of a sudden it's boiling hot, and then you turn it the other way and nothing happens, and you turn another way and nothing happens. You turn it 3 times again, all of a sudden it's freezing cold again. In other words, there doesn't seem to be this patience to wait for the impact of what they're doing to effectively filter through, and then to monitor that effect and adjust on that accordingly. And I think, at least for me, the bond markets, which, as you know, are the smart markets, that's
the comparative rather than absolute statement, though.
Yeah, but they seem to have sort of said, well, do you know what? We're just going to seize a little bit of control here. So what the gilt yields I've just described are saying is that, you know, rates are too high. They're simply too high. But we've got an employment number out today just before we started the call, which suggests that, you know, the committee may be a little bit more sluggish to ease again. Well, what we're describing there is you know, is that reluctance to effectively, you know, anticipate what is around the curve rather than wait for it to come upon you and then pull a huge chunk of sort of brake lever. So yeah, that's where I am. I mean, we haven't had these moves in US rates, not the overnight rates yet, but again, the US Treasury market is reflecting a similar type of movement, where you've seen yields come down at the front end Although slightly inverted still on the 2 to 5. I think when I last looked at the 2 years at 4% and the 5 is at 3.8. I think what will happen is the front end of the curve will probably drop, and when it does, will probably drop quite aggressively, and the back end will chase it back down. And in so doing, of course, you'll get that capital pickup in the underlying bond, which can be quite profitable. The difference being, if you're buying a bond, well, this is a classic example. I'll pull it up. If you'd been holding the 2061's UK Treasury a couple of years back, you'd have been holding them at about 90 pence. And they're trading at, I think, at about 33 today. Now, that's an inconceivable loss of capital on a, what is effectively a sovereign bond.
I guess where my sort of hostility to the concept of central banking comes from is, the 20th century showed that totalitarian, sort of top-down big state-directed economies are only really good at killing lots of people. You can't fundamentally have a state-run economy because it just doesn't work, because the free market has shown throughout history that it's a superior way of allocating capital. And without incentives, you just don't have a functioning economy. What is central banking if not just an outgrowth of the big state in monetary form? So what I can't see is why people even accept this regime without question. I think it may come down to the fact that there's no bigger dialogue about the nature of money or the fundamentally what investment and saving is all about. But I just find it obnoxious, the idea that let's put name. So Russia, China, every communist or state-run economy has collapsed. And the only ones that survive are ones where they survive by brutality, which it seems like the UK is now fast becoming. But they don't function. They simply can't function because it's since time immemorial we've seen that the Adam Smith's free market is a better allocator of capital. Why is there not greater pushback against the role of central banks? Full stop. I now find inconceivable.
I don't know the answer to that, Tim.
Do you have any sympathy with the argument, though? Do you see where I'm coming from? Which is, we accept that government shouldn't be allowed to do big schemes, because when they do big schemes, HS2 in the context of the UK being a classic example, they just cock everything up. So let entrepreneurs get involved, risk their own capital, and if they fail, they fail, and if they succeed, they succeed. But I guess where I'm tracing all these things back to is, and I'm not trying to be deliberately sort of, controversial, I'm just stating my own opinion. For me, this goes back to 2008, which is, global financial crisis. They bail out most, though not all, of the banks. And in the process of bailing out the banks, the problem goes unresolved. Bad businesses should fail, and bad managers of bad businesses should be fired. But it became clear in 2008 that there was so much regulatory capture on Wall Street that was never going to happen. And now that regulatory capture on Wall Street seems to be everywhere, in every sector, not least the pharmaceutical sector. So I have this existential angst about the way that the whole markets are moving, and I don't think it's in the free market direction.
No, I'd agree entirely with you. And, we may as well get onto the subject of the current government. This is probably as bad as it's ever been, I suspect.
Keir Starmer's honeymoon period didn't last very long, did it?
No,
not that it should have done.
Doomberg did quite a brilliant piece on this. Doomberg is a Substack that I think you're familiar with, Tim. But I'd certainly.
Do you read Doomberg, Paul?
Definitely, yeah. But they did a piece back in July entitled "Electing Poverty." It's such a brilliant read, and what it effectively is saying that this is a government that. Nobody seems to have voted for it yet here it is with some sort of massive majority, run by
luxury communists.
Yeah, luxury opinions. And, it's going to be run like a law firm, I suspect, at the end of the day. I think Keir Starmer is one of these people who thinks that, lawyers, got the answers to everything. But it could be a particularly grim 5 years, this, as we descend further into, this impoverished state we find ourselves in. And at the vanguard of that, I suspect, will be our energy policy, which is, likely to prove ruinous, irrespective of what your belief is on this.
But there's no popular mandate for this. Nobody voted for it. It was snuck into legislation. And this is the scariest quote thing I've come across over recent months and years is that you can vote your way into communism, but you have to shoot your way out.
Yeah. There's a brilliant quote actually that I think you've read The Madness of Crowds.
Yeah.
Yeah, but the one that sticks out for me is men, it has been well said, think in herds. It will be seen that they all go mad in herds while they only recover their senses slowly and one by one, which I think is what you're saying. People are probably going to come to their senses, but slowly.
I think people sit up and listen when the markets actually react. That when it hits people's pensions, when it hits their currency spending. And I think that's when people want change. And kind of until then, I think they will put up with quite a lot. And it's a similar situation with regard to presidents and the stock market. If the stock market's doing well, usually the incumbent has a better chance of staying in power. And it's a sentiment thing. And one of the things that is very important to look at from a technical point of view that often gets overlooked is what is the broader sentiment that's driving the market. Is the market 1999, 2000 type, everything's going to the moon, bullish on tech and very similar before 2007? Or is it we all think that this market is going to go down and it's very negative and sort of piecing it all together? But with regard to broader man on the street type changes, unless you get a very big market event, and I think this kind of speaks to what Tim was asking about, why isn't there more pushback against central banks? I believe it's got a lot to do with people just get on with their business day to day and just don't think about it until it personally affects them. But when you get a big crash, that obviously affects everybody. So that's when there will be call for change. So I see it as an eventual call for change. But in between, perhaps there might not be so much noise about it, and just people who have done their research, like you, Tim, will pick up on it and say, look, this is wrong. I mean, also in the book that you mentioned, Tim, the 40 centuries of, was it wage inflation, did you say?
Well, wage and price controls,
Wage and price controls. So, I mean, that's amazing for two reasons. One, it's such a long period of time that obviously you're seeing a repeating pattern, but it's also such a long period of time that a small fraction of our life can just be a small part of that cycle where they can get away with it for, another 30, 40 years. And it could still be part of that cycle, but it's outside of our own experience.
But we're touching on the role of history, though. So the historical record just in the last century is undeniable, which is since the Federal Reserve was established in 1913, the purchasing power of the dollar has fallen by around 99%. And that's one of the core objectives of the Federal Reserve, to maintain the purchasing power of the dollar, i.e. sort of control inflation. So, the absurdity of this is already a matter of public record. There
was a brilliant, actually I should have screenshot it, and I was going to screenshot it for you and send it to you, but there's somebody, and you may have seen it already, but there's somebody who'd showed like four or five gold bricks and said this could buy you a house in whenever it was, 1910. and then the same bricks could buy you a house in 2024.
It's a store of value.
Yeah.
Yeah, it's Matthew Peidenberg has a great story about that. Where I think the number he uses is $20,000. So he puts $20,000 in a shoebox in, let's say, 1920, and then there are 25 bars of gold, sort of Cadbury-sized bars of gold. Which happened to be the equivalent amount of money in those days to buy the house. So you can either give the shoebox of money over and buy the house, or you could give the shoebox of gold over and buy the house. Now, zoom forward to today, where the average house price is $500,000. If you've still got the shoebox full of money, it's worthless.
Barely going to pay the tax.
You're barely going to pay the tax. Whereas if you've still got the shoebox full of gold, you can buy the house. And the point that he's making, and this is at quite a high net worth, if not uber high net worth level, but I suspect this will filter through. And I think it is if you look at mechanisms such as the glint card, which I think is quite fascinating, which is effectively gold-backed spending. Is what he's saying is, well, people are now saving in gold effectively, and then just when they need to make a purchase, they're just transferring that gold into a currency into which they need to make the purchase, using the currency to do that, but nevertheless keeping the vast majority of the capital that they want to save in physical gold.
It's very interesting. Yeah.
And that to me seems intuitively right, not on the basis that I think it's right, or Tim thinks it's right, or you think it's right, Paul, but on the basis that, demonstrably, empirically, if you look over the last, however many years, 100 years, 1,000 years, or whatever, the store of value remains effectively the same. Now, we kicked off the conversation talking about, the levels of debt, not just the public debt, which is profound, but the levels of private equity and these sort of poor quality credit books is probably unimaginable. So the monetization of this debt is an inevitability. It's not something that all of a sudden, a brave politician's going to draw a line in the sand and say no more. Central banks, as we've just discussed, are not really responsible for this, and I suspect largely, ultimately political. So how, therefore, do you safeguard against, what is just the inevitability of the loss in purchasing power of whichever currency you happen to be dealing in? And I think the answer to that, and well, there are two answers, I think, given where we are today. The first one is physical gold. And the second one, and I'm not quite sure about this, but I think possibly the second one is Bitcoin. What are your thoughts, guys?
I'll let Paul speak first on the Bitcoin front.
Yeah, well, I guess the question was, how do you hedge yourself against a declining currency? And that could be different currencies depending on where people are in the world. So is it the dollar? Is it the Swiss franc? Is it the euro? That really depends on where you're sitting and what you're trying to achieve. As we sit in the UK, we have to be mindful of where sterling goes. And at the moment, the best sort of hedge is either to buy assets that can give you a return that cover that rate of loss, or to buy hard assets that other people would want, i.e. gold or silver, as a hedge. But you've also got to be careful as to what you buy in terms of precious metals, because they're not all moving up. It's just gold and silver at the moment. Palladium has been in a downward trend, hasn't really turned, and platinum is just sideways. So there is still more to come potentially from those trends, but at the moment, gold and silver, and gold's outperforming, silver seems to be catching up. So the idea that you might hold in some way, put money into gold and then move it into another currency when you need to make a payment is a very interesting idea, very attractive idea, but it would also need, how practically that works, I'm not sure, but I'm sure that those things can be solved quite simply. It's just the same as doing a currency trade, I guess. I guess also the other thing is the people's biggest value is the value of their home, if indeed they own one. So at some stage, and there are different times with which to buy and sell, but at some stage owning your own home has to be a priority, because otherwise you'll be chasing something that becomes more and more unaffordable over time unless there's a housing market crash. But again, that's an illiquid asset, so it's very difficult to trade in and out, as it were. So that's a question of just getting the timing right, which is again is difficult. But as we've spoken to Akil, and property cycles have a certain predictability that can help with that. With regard to Bitcoin, again, it is a kind of a risk-on asset in the sense that it's not paying you a dividend, and it's highly volatile, and it's something that could be put in any portfolio as a hedge, because it tends to not follow completely with correlations to the main stock market. So it's an attractive asset class just because it has big trending moves, and at the same time it doesn't seem to work one for one with equities, but it is still considered to be a risk-on asset, and it could be considered a currency. And I was talking about this the other day with someone about the idea that Taleb was saying that it can't be a currency or can't be used as a store of value because it's too volatile, which I always thought was a very strange statement, given that we've just seen what's happened to the Japanese yen, which was collapsing and is now, currencies are well known for over time making very aggressive moves. And again, it depends on what currency you're talking about, whether it's South American or whether it's some of the more stable currencies. But either way, Bitcoin is at the moment, and I think this is all you can say about assets at any one time, that there is never this is what you do and you just shut your eyes and forget about it. Gold seems to work over the very long term. It will go down in a crisis because, as Tim will say, and quite rightly so, it's used as a cash machine, but it's still a protection. And at the moment, I think Bitcoin will work as a hedge against a ever inflating debt pile that the governments are bringing on and bringing us towards, a final showdown with whatever that ends up being, whether it's a move to CBDCs or whether it's monetization of the debt. I'm not sure, but I also think that post a crash, or perhaps even as a signal that the market is going to crash, I think we will see Bitcoin go down, because there will be this desire to jump out of so-called riskier assets and taking profits on things that have gone up a long way. When the market starts to look very nervous, I think it will react like that. So Bitcoin itself is a very interesting asset, and but it depends on timing as to whether it will work. And I think at the moment it will work, but not forever. Tim, what's your take?
I'll try and give a very brief answer, because I don't know very much about this topic. Paul alluded to sort of things being perceived as risky, and I think that this gets to the heart of the problem, which is nearly everyone has an incorrect perception of risk. So I'll give you my classic definition of risk. So risk is 100% encapsulation of risk is you work for Lehman Brothers. You're a middle manager or whatever you're doing at Lehman Brothers, and you've got your life savings in Lehman stock. And, obviously you depend on, you pay your mortgage through getting your salary every month. And then September 2008 happens, and your life savings evaporate and you don't have a job. So you've lost everything. Now that's risk. But the day-to-day volatility, the price volatility of stuff, it's just noise. It's not risk, it's volatility. But unfortunately, the way the investment industry tends to work is, whoever said, it was the scientists that said, whatever can be measured will be measured, So if you can come up with a figure of, that's volatility, that's risk, people will use that. In terms of Bitcoin specifically, conceptually, I have to be supportive because I have to believe as a libertarian that, let 1,000 flowers bloom. I've already said I don't believe the state should be involved in money at all. So let a free market decide. The only real reservation I have in relation to Bitcoin is that it's, as I understand it, it's an entirely electronic form of money, that it's problematic as and when the electricity grid goes down. I don't know whether that's correct or not. So in other words, it kind of depends on the sort of the status quo for grid sustenance, if you like. And because I don't code, I've no way of independently verifying whether there are only going to be 21 million units or not. So I take that on trust. Whereas the thing about gold, and I don't dispute that they're sort of duking it out, but the thing about gold is it's never needed any independent, validity whatsoever. The beauty of gold is that it's no one, much like Bitcoin, is that it's no one's liability. So let's say comparing currencies to either gold or Bitcoin, I think is pointless because you're not comparing apples with apples.
Yeah, I guess there's an acid test on this one. If you've got three options, let's just make it simple: £1 million of the cash, £1 million of the physical gold, or £1 million of the Bitcoin. You can choose one of the three. Whichever one you choose, you have to hold for 10 years. You can't get access to it.
But that's a slightly to be fair, Jonny, that's a slightly artificial exercise, because you could say, a pragmatic response would be, why not have all three, or more specifically, have the latter two,
or percentages of.
Exactly, or divvy up the pie however you think.
Yeah. But
we know, for example, in the history of gold, that it was made illegal in the US in 1933. So the authorities have gone after it in the past, albeit during a kind of gold standard regime. So the reason why I don't think any investor can go all in with anything is because you have to bear in mind what absurd politicians are capable of doing, which is absurd things. So in other words, we're, I think, at an almost unique stage in history where you can't be too diversified. No, it doesn't mean you have to own everything.
I agree, and I wasn't suggesting it's an all-in option. I'm just saying, given the three choices, which would you go for?
But I think there is there are some standalone red flag options, and that one is cash.
Yeah. So
A because it's basically a government liability, and B because it's it's kind of like low-hanging fruit whenever the government wants to misbehave. So I guess that sort of sums up my view, which is B. In other words, if there's something I'm most, and I'd be interested to hear your thoughts, Jonny, but from my perspective, the thing I'm most interested in is getting a government-proof portfolio right now.
Oh, well.
A politician-proof portfolio.
I mean, of course, and for cash, you can read bonds because it's one of the same things.
Yeah, exactly, because they're pari passu, effectively.
Yeah, and the carry you're getting on them is negative real anyway. So a government-proof portfolio, Tim, I mean, yeah. I mean, for the first time in my life now, I am seriously thinking about what I can hold outside the system.
Which is quite a statement, to be fair.
Yeah, it is. I don't mind saying either. For the first time in my life, this is the first government that's genuinely scared me. So when you add the two together, what options are there? I guess the easiest option is to live a fairly monastic life and not have much that the government can take, and effectively, enjoy your life in perhaps a more organic way.
Some of that strikes me a bit like defeatism. In other words,
possibly,
for anyone that has assets, that has capital, or that has stuff, that seems like a defeatist approach to sort of tyrannous.
Well, then I think I'd refer you back to, smarter man than me, this guy Matthew Peipenberg, who now works with Von Greyers, who is empirically reporting that, high net worth clients, global high net worth clients, and we're talking about seriously wealthy people here, and I suspect they wouldn't admit this if they were asked anyway, but I think they are probably now using, physical gold to save. And that physical gold is probably in a cave in the Swiss Alps somewhere.
As well as Bitcoin, to be fair, I think there are, as a hedge, I think a lot of high net worth individuals would want to explore that option.
Yeah, I think because again, I'm not terribly educated when it comes to cryptocurrencies. But I think if you've got your Bitcoin locked away in a robust digital safe, and it doesn't matter if the electricity grid is on or off, as long as there's locked away in that safe, and you can access it through whichever code you have to use. Effectively, you have it. No one can theoretically take it away from you. How on earth you switch that from a binary code into a tradable currency, so you can buy food or pay your electricity bill or pay a tax bill? I have no idea.
So here's a question then. This is coming across to me as a somewhat sort of negatively inclined podcast. Not that we've done too many that are necessarily positive, but in as much as one's looking for reassurance or, let's say, sort of bull arguments, I mean, obviously currency is one thing, and then we can talk about sort of individual types of assets as well. In terms of, let's say, putting to one side the potential issues over government sequestration of assets, government seizure of assets, governments behaving like governments do, politicians behaving like governments do, if it was straightforwardly a maximize return mandate, what in the world would drift towards top of your list there?
That's a good question. Well,
I mean, and then they may be the same, maybe similar answers, to be fair.
Yeah, well, my view is my view at the end of the day. I think, I'm definitely in capital preservation mode at the moment, so I am cautious. I think the immediate outlook is unclear, and I think it's fraught with danger. We've discussed some of that. We haven't quite discussed the liquidity risks, but that's the other one that I'm constantly concerned about. But going forward, I would have said, whilst we are having a somewhat gloomy conversation about, all these macro forces, ultimately things need to happen. People need to eat, roads need to be driven on, bridges need to be crossed.
Politicians need to be guillotined. Some of them, not all of them.
I think the other thing that I'm very aware of as well when I speak to people is busy people and tend not to think outside of where they are. We're very first world here in the way we look at things, whereas actually the vast majority of what happens next is going to happen elsewhere. And you've got several massive drivers of growth in the world: India, Asia, ex-China, Africa. So I can't help thinking that, whilst short term I think there is the potential for some serious holes in the road. Ultimately, what's happened over the last 50 years in the West is likely to repeat itself in other parts of the world. So there's going to, I think we touched on copper earlier, but global copper demand is whilst in the short term it may turn down, but in the long term, that's almost a sort of no-brainer, I would have thought. energy provision. Energy is life. I mean, this is what Bloomberg say, and you've got a simple choice with energy. You can either hold yourself to ransom and import it through global energy markets, or you can plan sensibly ahead and make sure that you've got a base level of energy that is independent. And I think if you agree with that latter part of the statement, then I think you're probably looking at a bigger nuclear output in the future. So that's, in answer to your question, Tim. That's and that happens to correspond as well with this bifurcation between where commodity markets are now and where stock markets are now. You've got this what the technical term of these alligator jaws, where the commodity markets generally are at sort of all-time lows relative to where equity markets are. And
do you think, sorry to interrupt, Jonny, do you think that's a function of ETF type flows, sort of passive flows, that people are going just where the growth is?
I think so.
Irrespective of valuation?
I think so. I mean, you and I have discussed this many times, specifically with regards to the valuation of precious metals, mining companies. But I think it's across the commodities piece. I mean, there's, just what the current government's stance with regards to the taxation of British energy companies gives you a clue. The valuations, I think, are just there's a company. I'll be specific here. There's a company that I look at in the UK called Serica Energy. And Serica Energy is a company that produces North Sea oil and gas, roughly in equal measure. Now, Serica Energy is trading on a multiple of sub 3, with a distribution yield of 17% and change. Probably about 20% of its market cap is in cash. I think 25% of the equity is owned privately. Now, that's an extreme example of something that's quite clearly wrong. And the reason it's wrong is largely, the market sentiment towards companies like that. So I guess the question is, if you were running that company, what would you do? Would you pack up and cash in, or would you move it elsewhere and try and eke some value out of it that way? Would you just keep quiet and pocket the dividend? It's a very difficult one to call, but I think on the basis that so much of the West's energy policy now is going to become, what's the right word to use? Intermittent. Let's put it like that. Fragile. Yeah, by virtue of the fact, it's focusing on wind and solar. I would have thought the energy sector is probably an area that over the next 10 years certainly is probably worth some investor interest.
You mentioned earlier about UK gilt yields, just generally going lower further out.
Yeah.
And whether the market is predicting that rates are going to go lower ahead of perhaps what the Bank of England is doing. What do you think is actually behind it? Do you think that the UK is actually slowing down more than they're seeing and rates will go down? And if that's correct, wouldn't that be a positive for the stock market?
I think, Paul, for me, the last sort of 5, 6, 7 years has been a story of, bad news is good news. So, when we see a slight slowing down of things, then you know what's going to follow, and you can get on the surfboard and ride it in. For me, I think we're at the start of a slightly new paradigm, which is, bad news actually is bad news now. And what I think the gilt markets and to an extent the treasury markets in the US are doing, is signifying a slowing down of things. And this isn't being helped by, Bank of England policy of selling, effectively selling gilts, which is reducing liquidity further. So short term, might it be a positive? Possibly, yeah. I mean, these are short term trading bets, I suspect. But no, for me, what they're signifying is that these high valuations are highly likely to be unsustainable if there's a material downturn in earnings. And the fall in what we've seen now in terms of the bond markets, they're signifying the fact that rates need to come down, and they need to come down sooner as opposed to later. And the reason for that is that the economy needs a bit of fuel. Well, if you go back to what I said about the fool in the shower earlier, it's highly likely that it's a bit too late.
But don't they do that all the time? I mean, the other analogy that gets used a lot in economics is the brick and the rubber band. You pull it and nothing happens, and you pull it and nothing happens, and then suddenly the brick suddenly moves. So the economy is like that, and it's why I use technicals, because the market is forward looking. It doesn't look backwards, and all the people who make policy decisions are studied in classic economics, which we know doesn't work, and they're looking retroactively at figures that the market's moved on from. The question I want to ask you about time frame, when you say short term and long term, what does that mean to you?
Well, I mean, short term gilts, I would say, class anything out to about 3 years, 5 years.
Right.
That the chances of any material movement in the capital value of those instruments is pretty slim. And the way I describe a yield curve to people is imagine holding a whip in your hand, and you sort of flick the whip. Well, the short end of the whip is in your hand. It doesn't really move a lot. But the long end of the yield curve is the bit of the whip that goes through the sound barrier and makes the crack. And that's the impact of the sensitivity of the yield curve in terms of how it reacts to these movements. So we mentioned the 2061s a little earlier in the conversation. Well, if we were talking about those a couple of years back, they'd have been trading at or around 90. Well, I think I've got the chart in front of me here. Hang on. Yeah, there we are. They're trading at 31.13 today.
The risk-free rate for anyone that's not paying attention.
Yeah, that is the risk-free rate. Yeah. Now, to put a little color on, what I'm suggesting may happen is if we do see the Bank of England drop rates, and when they do it, they'll do it aggressively, I suspect. You may get the front end drop further from where we are now. 1 year gilt is on 4.3. Let's just say that moved down to 3.3. Well, that would effectively have an impact right along the curve. Well, the impact as you move along the curve, as I've described with the analogy to the whip, the further you go out in the curve, the greater that impact. So you could comfortably see that at 2061, I suspect, move from where it is now, call it 31.5. It could move to, 50. Well, that's a big trading gain. But if we go back to what we said earlier, if I said to you, well, you got to hold this for 10 years, what's in it for you? The running yield on this gilt is 1.6%. So, even at today's inflation rates, which are substantially lower than they were, 12 months ago, not that I think the published inflation rate is what I call the personal inflation rate. I think people's individual inflation rates are significantly higher than the published inflation rates. But there's a negative running yield on that. So you're holding something for 10 years. That is effectively just a loss-making investment in a currency that we've all agreed is likely to lose its value over that 10-year period. It doesn't make any sense to me.
Yeah, definitely. I mean, when I was saying timeframes, I meant market market timeframes as opposed to bond timeframes. So you said in the short term the market might go up, and I thought, well,
sorry.
yeah,
Well, no, I would have thought. I don't have any insight into when the bank is likely to move these rates, but when it does, I suspect it'll move them fairly quickly. I mean, I think you mentioned the chances of a 75-point rate cut now in the US before Christmas. Well, I think statistically that the move in those predictions has literally happened in the last 6 weeks. So if you go back 6 weeks ago, there was broadly a 0% chance of a 75% basis move. And now I think the chance of a 75 basis move is certainly over 20%. I don't know the number. So that's what I mean by in the short term. It's this is all likely to happen very quickly when it does. And I think this is what we saw recently. I mean, Tim will certainly be able to back me up on this, but every time we get these fractures in the market, that they move. I mean, it's so unbelievably quick in terms of how quickly the damage is done.
Talking of Japan, Tim, there was a while back, and I'm going back a few years, that you were very bullish on Japan, and quite rightly so. Are you still bullish on Japan?
I think still bullish on Japanese equities, but Japanese bonds have been sort of, here be Dragon's Land for as long as I can remember. So I think I'd still be bullish on particularly sort of Japanese exporters. So I think, although the BOJ, the BOJ is basically thrown in the towel. So they've tried to hike rates, and markets told them to go play in the traffic. That's capitulation. So, putting the currency to one side, Japan's still a cheap market, and because it spends so much time in the doldrums. And I repeat, again, a quote I've used ad infinitum, which is the manager I met back in around 25 years ago that said Japan was a dress rehearsal, the rest of the world will be the main event. Well, Japan's been out of favor for so long now. It's cheap. It's missed out on the best part of 30 years of stock market, hyper growth. So, and the reason I'd still be bullish on the particularly the exporters, the large cap exporters, is those Japanese companies that are still around after the grinding deflationary depression of the 90s and the noughties. They have bulletproof balance sheets now, so they've literally been to hell and back. Whereas for the rest of the world, particularly for the rest of the West, the joys of the Japanese experience are still ahead of us.
That's a phrase to remember, isn't it?
So I think on balance, it's certainly positive, but I just get the sense, reinforced in part by this conversation, that this is an abnormally fraught market environment, and it feels like dancing on the edge of a volcano and doing just about everything, with the exception of sort of the real asset stuff that we've again discussed ad infinitum. So, suffice to say, I think the 60-40, if 60-40 isn't dead, it certainly feels like it's dead.
Yeah, it's amazing you should say that, Tim, because I just tried to sort of put a slight executive summary together before we met today. And the three things I've written down in order of what we discussed earlier, and again, I refer people to Chris Vermeulen on this, but it looks pretty obvious to me that we're in a stage 3 topping phase. That's the first thing.
Just before you go on from that, how do you define a stage? What is a stage 3 topping phase? It seems very... who's defining what the stages are?
Well, the stages were I think initially defined by Sam Weinstein, and it allocates a particular stage to a particular part of a stock market cycle. So stage 1 would be recovery, stage 2 would be bull, stage 3 would be topping, and the stage 4 would be decline. So not a million miles away from Akal Patel's cycle studies.
Or Elliott wave, perhaps.
Oh, yeah, Elliott wave for sure, yeah. And, and I know Tim and the lads, I know pay some attention to what Avi Gilbert has to say. The second thing I had written down was, stock market cycles, and by stock market cycles, I mean market cycles typically lead economic cycles. So, and I do think the bond markets are effectively, discounting what is likely to happen going forward. And I think if rates do come down, that'll be because, economies are starting to slow down and grumble a bit. And then finally, I wrote, peak risk is now. For me, this is, if, there's a test I do regularly, which is the blank piece of paper test. So if I was starting now, what would I do?
That's an interesting thought experiment.
Yeah, and the answer is, I can get probably 4.5% on cash, which is a damn sight better than the running yield you're getting on that gilt I mentioned. I mean, you're getting a lot more, obviously, if you come closer into the curve. I think it's 4.3 on the UK 1 year, but you're getting liquidity, and you're preserving your capital. And if there is a reset, then the valuation arguments are suggested by Tim in Japan, and possibly in the energy sector, as we've discussed. And then there's some great alpha to be gained in the precious metals when they find the bid. I think capital can be quite profitably allocated at that time.
Yeah. I've just had a quick look at Stan Weinstein's cycle analysis. It's basically Dow theory that he's taken, which is about sort of 100 years before him. And it's... But I think he's just simplified it using moving averages. But the point is the same. It's so you end up with a basing phase, a trending phase, and then
Correct.
a reversal phase. And these are very big phases. But that's that classic Dow theory. And if you think you haven't heard of Dow theory, you kind of have, because every day you look at the Dow Jones Industrial Average, and he's the guy who created the Dow Jones Industrial Average with 20 stocks. And then it became 30 stocks, which is the 30 stocks that we look at today. It's the longest running index before the S&P was created. But so the point of that is we're in this if we're in a stage 3, we're in a reversal. So it means that the market might go sideways for a bit. That's usually accompanied by very bullish sentiment, extreme bullish sentiment in the market, which is the only piece of the puzzle that I'd say at the moment might not quite be there. I think there's quite a lot of negative sentiment out there that might press it higher. It depends where you look, isn't it? It really depends who you talk to. You might say that the retail investors are very bullish, and the professionals are actually quite cautious. But it is difficult to pass out at times. But I would say that at a major top, such as stage 3, as you're describing, you would have something closer to the excessive bullishness that we had prior to 2007, and basically prior to the dot-com boom and then following bust. But it depends how you measure it, and that's open to interpretation.
Yeah, absolutely. I mean,
the joys of the market.
The joys of the market. For me, the stage 3 is it does provide moments of exuberance, and I think we've seen that. I mean, the fact that 20% of the S&P is reflected across the market cap of 3 stocks, I think is evidence of that. But I don't think it's, for example, the same as a stage 2 where you can broadly, commit capital and just let it run. I think it's all about understanding that, at moments, at peak moments, it probably pays to take some capital off the table and just keep it dry.
What do you think of the Russell 2000 suddenly going up and showing a bit signs of life when everybody had sort of pronounced it dead?
Yeah, it's a very curious one, that. and it's come back again now, hasn't it? I mean, I would have said the Russell is probably the index mostly reflective of the US economy.
Okay.
And yeah, there was clearly a transfer of capital. I think when we saw the Mag 7 sell off, at the back end of June and early July, the capital moved into the wider economy. But I mean, I'm making the narrative up, but probably on the back that rates were going to fall, and everything was going to be okay, and bad news isn't so bad. It's going to be quite good because it's going to play into the wider sector. But I think there's been a big revision in that. I think there's been a big revision in that thought now. I mean, the Russell is back to where it was, late May.
Yeah, it is, but it has kind of broken out. It was the break over 2000, I think, was quite significant. I mean, it made a bit of a meal of it before it did that, but yeah. I mean,
the moving averages are, when I last looked, seemed reasonably intact. But
I wondered whether lower rates would in the US they suddenly realise that there's been this whole AI story, and taking it off the technicals just for a moment, and I like to posit some ideas that might come to fruition, even though it may also be incorrect. But the whole AI story is a very interesting one, and it's actually the people who are selling the AI that are making the money at the moment. But there should also be a trickle down effect, because this is technology, and this technology could benefit lots of companies. It's just they haven't had the time to implement it. They haven't got teams of coders and programmers and what have you, with which to data mine and do all the things that you can do with it. So I think there's possibly two things at play here. One is that interest rate cuts tend to help smaller companies more because they find it harder to borrow compared to the big boys. And secondly, there could be a trickle-down effect of AI and technology that will give them efficiencies in their business. It's just two very general points that I think might account for perhaps a surprising short-term move up in the Russell 2000, even if it's not sustained.
Well, I agree with that. I mean, my experience of AI at the moment doesn't really extend much beyond ChatGTP. Tim, a good mate of ours, Andrew Clark. I don't know whether you got this note, but it was a note, I think, that appeared.
The energy expenditure problem.
Well, it was a note on
the whole thing being overhyped as well.
Oh, that's inevitable, isn't it?
Yeah, but basically, I think Goldman Sachs reported that yes, AI can, for example, deal with and update historical data in their company models more quickly than doing it manually, but it costs them 6 times more.
And you need to set your operations next to a nuclear power plant to fuel them.
So invariably or undoubtedly, this is all going to play out. But at what pace? And I guess the key question is: are the valuations going to be sustainable given the pace of the rollout? Yeah, and that, I think, upon that question, lies the next 6 months. And we all know that today's market leader is especially in today's world where innovation is constant, and the moats that companies set up are ironically the biggest moats in the world remain the commodity companies, but in the high tech and innovation space, the moats are both shallow and quite small. So other companies can do this and perhaps do it better and less expensively.
Are there any other countries that you analyse other than, I guess, obviously the UK, but clearly the US? Are there any other jurisdictions that you think are looking interesting or have caught your eye that you think are worth investing in?
I'm always ready to bow to other people's experience on this matter, Paul. And certainly in my experience, the key to this is finding people who know these markets, and moreover, people who you can trust. So, with regards to the Asian markets, my go-to is Samrang and a fund manager called Greg Fisher, who I genuinely think tells it as it is. He doesn't talk his book up, he's not always ahead of the curve, but I think you get a very clear picture of what's going on in Asia, excluding China.
Given he's someone that you trust, what is his opinion on the Asian region?
Well, simply put, he wouldn't advise you to invest a penny into China.
Okay.
And he thinks that, as Tim has alluded to, off the beaten track, good Japanese companies are trading at really good valuations. And there is an element of if you want reform going on in Japan, corporate reform, which is positive. And in addition to that, other jurisdictions such as Vietnam, Indonesia, Malaysia, they're all very interesting markets with many opportunities that he finds attractive.
Yeah, Vietnam, Tim. I seem to remember you mentioning Vietnam as a potential.
Yeah, we've invested partly on the back of Greg's interest in the Vietnamese market. It hasn't necessarily delivered to our expectations, but I think in the bigger picture, if you're going to make a bet on, let's say, the US versus Europe versus Asia, and as John has already alluded for us, that would be probably ex-China, then Asia has to be the place you'd go for growth on a selective basis. Because people always treat things like it's, you have to own a region or you have to own an index. No, there's always opportunities in individual stocks.
Oh, for sure. Yeah. I mean, your discipline is value investing, Tim. Is that similar to how you approach valuing stocks, Jonny? Is that you obviously use technicals as well, but is your primary analysis with value investing?
Absolutely. Yeah. It's it's the way that I think everybody was taught. When I came into the market in the early 90s, the key thing, I mentioned Serica Energy earlier, and I mean that that whilst that is demonstrably cheap, it could well prove to be a value trap. I think the key is to understand what is something that is likely to continue to have traction in the coming years, and you're picking it up at a price that is effectively sensible at the end of the day. I'm not saying that Nvidia isn't a great company, and Apple and Tesla, they're all fantastic businesses. I mean, there's no doubt about that. It's just that, are you prepared to pay today's valuations, for tomorrow's earnings? And I think, in my opinion, now is not the time to take that risk on. I think.
Sorry, I didn't mean to interrupt you.
No. I think if you then work your way down the valuation ladder, you can pick up some great companies. For example, Antofagasta, which is a probably the largest copper miner in the world, trading substantially less expensively than the companies we've just discussed. But you've got the potential short-term threat of maybe a global economic slowdown, which is going to impact on the demand for copper. And then you've got, the most standard valuations probably lie in the precious metals sector, where you've got companies that, a broadly being given away at the valuations, but there's scant interest in ownership. So it doesn't really matter what you think about what they're worth. Nobody else is prepared to buy them. And so that momentum that you alluded to earlier, Paul, doesn't give the stock price a tailwind.
So looking at the chart of Serica Energy right now, obviously it's performed quite badly since September 22, but it's come back to a lot of support from July 21. How would you approach that then? Would you say, because it's a buy on a value basis, that it's time to buy it now, or would you wait until? Would you say this is a buy and now I'm gonna it's in the buy camp, and then once the technicals turn, I'll then buy it? I mean, you could buy it because it's at a support level, but do you look for confirmation? Is kind of what I'm asking on something that you like.
Yeah, definitely. I think for me, this is where the technicals play such an important part. With regards to Serica Energy, it's not a sort of company that I'd be looking at to invest for clients simply because the political risk in energy in the UK at the moment is so aggressive. I don't know if you can see this on your chart, but the new chairman of the company, chief executive of the company, made a sizable purchase of the shares at around the share price recently.
Okay.
Yeah, that's something that I think is noteworthy.
Yeah.
And they obviously think that, over the longer term, the company is worth substantially more than it is now. I mean, if you go back a little bit, I don't know how far you've gone back on your chart, but I mean, this company in mid-22 was trading at about £4.30. I mean, it wasn't especially expensive then.
Wow.
So, this sort of valuation can be found across the energy sector.
Yeah. I was looking at it from 2006 to date, and it's pretty much where it was in the highs of 2006. It then dipped into 2015 down to pennies, and then it's been on what would be described as an upward trend. You could still say it's in, but the upward trend culminated in a move up to 450, and it's now trading today at 128. But there was a big consolidation period between, August 18, July, August 18 to about May 21. So for a good few years, it kind of went sideways, trying to break above this 130, 128 to 130 area, actually just a bit more than that, 145. So the point of that being, it's come back to this zone that has been historically really important for the stock in terms of trying to break out to the upside on two major occasions, and now it's testing it as support. So it looks like a really interesting area, and that means that if someone from in the company is buying at this point, that kind of puts a few things together. But
yeah, I definitely think it's it's one of these sort of it's definitely an interesting company to look at this level. And as you say, there's a sizable investment as well in the stock of the company. So now a lot of people would say, well, he's likely to do that anyway. But on the yield alone, which is I think around about 17%.
What?
Now, even if you were to cut that yield in half, you're still going to double your money in about 6 years.
That's incredible.
Mm.
That is. Yeah, okay. Maybe that's normal in the value investing world where you hear about yields like that. Because of course, when I just look at charts, I'm not looking at the yield. Is that something that's unsurprising to you, Tim?
I mean, even in our world, that's anomalous. But as Jonny said, the thing is not to try and get trapped in value traps themselves. So everything depends on momentum and margin expansion and stuff like that.
Yeah. Yeah,
and to repeat, the caveat here is it's a particularly aggressive environment at the moment if you're in oil and gas in the UK. But looking at the share register and the private equity component of that, I mean, it wouldn't be inconceivable for the company to up sticks and move.
I mean, money goes where it's most respected. So that wouldn't be the UK and the UK offshore energy market right now. And not under the Labour government we have.
Yeah, you've had the big majors talking about this as well. I think BP has suggested that, you know, if it isn't shown more respect in inverted commas, it's quite happy to up sticks and move.
And what would that entail? Just it being an official American company, or
it just can relocate its operations. It doesn't have to. I mean, it would still be listed in the UK, but it can just relocate a lot of its expansion projects somewhere else in the world that respects proper capitalism.
Mm.
Yeah, and then of course the earnings wouldn't be taxed at such a punitive rate.
I thought companies did that anyway. I thought that it was actually very difficult these days, especially big companies, to work out whether they're truly a UK or US or European company, because, like, say, for example, Apple, it's got so many different operations in so many different places and dealing with so many different tax laws in all these jurisdictions, and with the best sort of money with the most amount of money in the world, they get the best minds, and they manage to deal with their tax bills the most efficiently, I guess is the best way to describe it. So
my take would be that the credibility of a country's government's never collapsed more completely and so rapidly than it has done in the UK in the last few months.
Yeah, I'd agree with that, Tim. Yeah.
And apart from it being a Labour government, where else would you say that that's manifesting itself?
Europe. Less so the US is, my take is the US is pushing back on a lot of this stuff on a state by state basis, but Europe by and large, or the EU is just a lost cause at the moment.
Jonny, was there anything else that we haven't asked you about that you wanted to ask?
No, I think it's been a great conversation. It's for me that there's no clear path from here at the moment. I think we've discussed some pretty broad aspects of where we are, and it would be very difficult, I think, to summarize what happens next. And given that, I'd repeat what I said earlier. My inclination, my instinct is at the moment to just be cautious and just to let things settle down. We've got a big election in the US for the end of the year. Clearly, the bond markets are shaking the cage with regards to interest rates. Is that going to be good news? Is bad news is good news, or bad news is bad news? We discussed that, Paul. I think that needs to resolve itself. There's significant risk across the credit space. Illiquidity is, something we haven't discussed much, but I think there's a huge amount of illiquidity in the market, and that could be a real banger if that went off. If there was a rush for liquidity, and it would be disadvantageous for gold, of course, because as Tim knows, it's not. Times of crisis is not what you want to sell; it's what you can sell. So yeah, that's where I am at the moment.
Let's do media picks. Tim, you go with yours.
I'll go first. Mine is a film called The Grand Seduction, which I think we saw on Prime. Possibly Netflix. I forget which platform we're watching it on. From 2013, it stars Taylor Kitsch and the national treasure that is Brendan Gleeson, who cannot make a bad film.
Yeah,
amazing.
And basically, the premise is like a sort of almost an inversion of a local hero. But basically, the synopsis is there's a Newfoundland fishing village of like about 100 and odd people. And they desperately need a new doctor to take up residence. So they have to basically do a charm offensive to get this guy on board. And it's just a wonderful film. And the best way to describe it as a comedy, I think, would be charming. Because there aren't that many charming films around these days. And I think the world badly needs charming films. So basically it's about how this tiny little village tries to go about sort of wooing this young doctor to ensure its future. But it's called The Grand Seduction, 2013. Don McKellar is the director, and it's just a wonderful and wonderfully funny family film.
Well, you had me at Brendan Gleeson. Excellent. Thanks, Tim. Superb. Jonny, what have you got for us?
A couple of things. I've recently got into the Global Warming Policy Foundation, which I would heartily recommend to you guys and anyone listening. It's www.thegwpf.org. And I picked up one of their pamphlets. It's Report 28, and it's entitled Global Warming, a Case Study in Groupthink. And it's written by a guy called Christopher Booker. It is an absolutely outstanding read. Yeah. A copy should be given to everybody, in my view.
Oh, yeah. Wow. One of those. Fantastic.
But the GWPF is well worth a visit, I think. One of the things that I try to encourage with my children, and I try to speak on finance when I can in local schools, is the ability to think critically about these things. And anyway, that's that. The movie I thought about is probably one of my all-time favorite movies. It doesn't seem to age, but I think it's particularly relevant today for me, given what the movie is about. And it's a Western, which is my favorite genre. But the movie Shane.
Oh wow! Never heard of it.
Yeah. Oh well, two things.
I've got
read
Joy.
Read the book, which is by a guy called Jack Schaefer, which is just an outstanding. It's just a bit longer than a short story, but the film itself is just sublime. It's a very simple story. Effectively, it revolves around a guy called Shane, who is an ex-gunslinger bounty hunter, who rides into a frontier town where people are trying to eke out a living in an honest and dignified way, and they're being harassed by a big cattle baron and this bunch of goons. And not dissimilar to the state we find ourselves in today, I think. We need, I think, more than ever at perhaps at this point for people to stand up and say, no,
enough.
And I just sense that's possibly happening on the fringe. But anyway, that's my pick. It's a fantastic movie, and it does have a strong morality to it as well.
Brilliant. That's why I love doing media picks, because you just hear of things that you've just never heard before, and you discover these gems. And the older the better, really, because they could quite so easily get overlooked unless somebody recommends them, as you have done.
I'm envious, Paul, because you're going to see it for the first time, and it's shot in glorious Technicolor.
Yeah, I'm looking at it now. The trailer. Have you heard of it, Tim?
I'm trying to think. Is it Alan Ladd? Is it Alan
Ladd?
Yeah, Alan Ladd. Yeah. It's the villain in it is
Bill Gates.
No, it's Jack Palance.
Same difference.
It's Jack Palance. Yeah, very little difference. Yeah. Yeah. Well, listen. I mean, do drop me a line when you've seen it, Paul. But I think, and as I said, that Global Warming Policy Foundation is well worth a visit as well. And I think it'll frame a lot of things that we've discussed about around the energy topic.
Brilliant. Well, thank you so much. I mean, I'll make mine brief. I just watched the Elvis film that's just come out on Amazon Prime, and it was recommended by a few people, so I thought I'll give it a go. It's very long, so it might take 2 sittings depending on how much time you want to spend watching a film. It has got its criticisms about the style that it's used, because it is very, for want of a better word, fancy in its transitions, and but at the heart of it is an interesting story. And personally, and I guess this I can only speak for myself, I would have preferred a story that centered much more on Elvis and not so much on Colonel Parker. But there is a story to be told about him and you know, how he manipulated and used Elvis, which I didn't know very much about until I saw it and then Googled stuff. So I suppose in that regard, it's done its job, because, you know, that is an important story to know about, that many people at the time obviously didn't know, and perhaps people are discovering for the first time. But some amazing sequences, some amazing performances all round, and very, very bold and interesting filmmaking as well. His voice was just pure gold. It was just incredible. And even when he was really ill. But anyway, thank you so much for coming on the pod. It's been a lot of fun, real pleasure. Just remind us where people can find you if they want to get in contact with you, and also tell us who your clients tend to be, because if somebody wanted to you know, hook up with you, what sort of clients do you accept?
Yeah, I think probably the easiest way to get hold of me is at the following email address. Is J for Johnny, M for Morgan, JM at Charteris, CHARTERIS.co.uk. And with regards to client profile, it's anyone who's interested in applying, you know, a common sense approach to, you know, maintaining their capital and growing it, you know, sensibly when the time is right. You know, one of the benefits of not having to, I know Tim agrees with me entirely on this, but one of the benefits of not having to sing the company song in terms of what you're doing and where you're going, and I think is a massive advantage. And so yeah, that's what I'd say. Anybody who's you know, concerned about the future, worried that they may be in the wrong assets, you know, concerned about the impact of currency devaluation, future inflation, you know, overvaluation, etc. Yeah, please get in touch.
And on the socials, do you tweet or Substack or anything like that they could follow you?
Now, Paul, this is always a bit embarrassing. I don't do social media.
Well,
so,
yeah, I barely do it, but yeah.
I do have a LinkedIn page, but I'm not sure I really know how LinkedIn works, to be honest with you. I find it a bit overwhelming. And I do read. I mean, Substack for me is the go-to news stream, really. There's just some brilliant writing on it, and some really informed writing, and also some, I think, original opinion as well. So, no, other than the email address, which I would encourage people to drop me a line on if they want me to you know, review things or maybe have a chat with them. That's it.
Brilliant. Talking to Substack, how's yours going, Tim?
Yeah, Substack's it's an extraordinary platform. So put it this way, the distribution that I send through the company, Price Value Partners, is a figure, and I've built that over, let's call it a decade or so, probably longer than that. And Substack is already twice that number, and I've been on for I think about 18 months. So Substack can build you an audience incredibly quickly. Yeah. You've always written well, Tim. It really suits you. I think Substack. But if that's very kind. But if anybody doesn't use it, you have to use it, because I mean, I think of the people I subscribe to, I think the only one I pay for the subscription service, and those that I pay for at all, is Doomberg, because the quality of Doomberg's commentary on energy is quite something else. But that aside, there's plenty of very high quality, a lot of very high quality writing that I just take the free version of, and it's better than you can get in a legacy media. So it's really a force unto itself. So yeah, if people aren't using it, I think they have to use it. I totally second that. Yeah. That's it is the place to get, you know, properly informed about things.
Brilliant. Well, Jonny, thanks so much for coming on. Obviously, we'll put links in the show notes to everything that you've, all your links and emails, etc. And look forward to having you back.
Tim and Paul, thank you so much for inviting me on. It's been brilliant. Thank you so much.
Cheers, Jonny.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.